I want to go over a trade that I made in crude oil. I actually entered the trade on January the 8th. If you look at this chart, this is my wave chart, and I put a white line just before I entered the trade, and then this was the line just before I exited the trade. The trade actually exited. I had a good close order, and it actually exited early in the morning before I was even awake. It hit. But what I did, when I trade oil, I tend to either sell calls or sell puts. Sometimes I'll also do strangles depending on where it was trading. And I was looking at the chart here, and I had this candle here, it was going down, and I had this pretty strong candle right here. And I really thought I was going to get a lot more support than I did, although the trade worked out perfect. I did think I would get a little more support, so it went negative on me a little bit before I finally closed it out at a profit. And what I did is I sold the call first. And that way, if I had to roll, then I could turn it into a strangle later. Sometimes if it's trading in the middle of a range, I'll go ahead and open with a strangle to begin with. But I really prefer to sell either the calls or the puts. In truth, I probably would have been better off selling the call right on this candle, but I didn't. I looked at this candle here, the sell-off here, and there was a lot of volatility increase. So I was able to get a pretty good premium. And what I did is I sold the 55 put, which was right here. And I got into it right here at 60.75 on this candle. I sold the 55 put, and I sold it for 30 cents, which was about $300. And then I put a good to close order in at about 60% of that, or about 0.18, and just waited for it to hit. I took a little bit of heat as it moved down right through here, and I was watching it, and I'd run some Fibonacci levels, and really it was hitting off Fibonacci support all through this area. It dipped a little below it here, but it closed above, and then we started getting a little strength and a little strength, and then we had a gap up on the open here on the 21st, and this is actually, it was during this trade, which was actually on the 21st, that I got out of it, and it was trading at about 59.67 or so. So right in the top of this range is when my good to close order hit, and I got out of the trade. I ended up with I got out of it at 0.18, so I ended up with about 124% annualized gain. I was only in the trade 11 days. When I sold this put, again, this was on January the 8th, and I sold the January the 31st put. So, I only had about 24 days or so in this. And I typically like to sell my short puts and short calls at about 14 days or less. So I was a little bit longer here, and it did work against me a little bit. It did take some heat, but I got the bump up here, and I was able to get out of it. I'm going to take a flip over and take a look at the actual trade sheet I used, and then keep watching the video, because I'm going to come back to this and talk about something else in just a second. This is the actual trade sheet. You can see I had the volatility when I entered was at 27.73. The trade had a 98% probability of success when I entered it. Closed out, implied volatility had dropped quite a bit, which is one reason I was able to get it closed out in just 11 days. There's a 3.75% gain on my risk, which is the amount of cash I had to secure this short put with. But annualized, because it was over 11 days, got 124% return, which is very good. Like I said, this one worked out really well, and I was very happy with it. And I actually entered in another one of these shortly after this, and I want to talk about that just for a second before I stop this video. On this candle here, which was the following day, I actually re-entered this trade. And what I was looking at here is, again, I was at this second degree Keltner channel, well below my wave. I had a previous uptrend, although the fundamentals have changed some, so you have to be careful with that. And I had a couple of trend lines here, which had been broken. So I went ahead, and these are some RSIs that I was using, and all of them had basically gone to oversold. This one, the 14 did not go until the following day, but it was pretty close right here. So I went ahead and sold another put further down for 14 days out at about the 51 range. I'm taking some heat on it right now, but I really feel pretty confident about this trade because I did just short a put, and everything is pointing toward this, making a move back up. because I don't need much of a move back up. I just need a little bit in order to get what I want out of this trade. So I still feel very confident about this trade. If I did have to roll it, like I said, I placed it 14 days out, so I'll have about a week out of it already, and then by Monday, Tuesday, I'll have about a week out of it, and so there will only be 7 days left on it. So time's working for me. I'm still expecting an up move. That's going to work for me. But even if it doesn't, I could roll this out and down even further. And you look at our 52-week low is right in this area. So, is oil going to break below that? Probably not. But if I did have to roll, I could roll out and down, and then I could also sell a call up in here. So I could turn this into a strangle, which is one reason I like to start with just a short call or just a short put, so that I have some flexibility when it comes to making adjustments should I have to make an adjustment or some sort of roll. Now obviously when you're getting this type of choppy action, you might go ahead and jump straight into a strangle to start with, especially this would have been a great spot to do that. Right here, honestly, I should have sold the call right here, but I ended up selling the put, so I messed up here, but I was still profitable on the trade. If you like this video, please like it. Please subscribe to the channel. If you have any questions or comments, please let me know. Thanks.